05's attention. What if the very paper that promised endless profit turned out to be a ticking time bomb? 510's authority. I'm Gregory Hale. I've spent 2 decades tearing apart Wall Street's murkiest trades, turning hidden ledgers into front-page stories. 1015's agenda. In this video, you'll watch how one analyst uncovered a cascade of toxic mortgage-backed securities, why the warning turned his skin ash white, and what the fallout meant for the global economy. 1530's disclaimer. For safety, the whistleblower's name is masked. The narrative follows a composite of real testimonies and documents. 3045's source intro. The first clue emerged from a 2008 SEC study that mapped the anatomy of the mortgage-backed securities market. The report notes that the complex layering of asset-backed securities amplified risk across the financial system. Source: SEC report. The analyst, let's call him the analyst, was a mid-level portfolio manager at a major investment bank. His daily routine involved poring over performance dashboards, a sea of numbers that most colleagues skimmed. One morning, while scanning the latest tranche of collateralized debt obligations, a pattern slipped through the noise. An abnormal concentration of subprime loans, all bundled into the same tranche, flagged for high yield, but lacking the usual credit enhancement buffers. He dug deeper, cross-referencing the tranche composition with the Federal Reserve's quarterly household debt survey. The Fed's own analysis warned that the surge in mortgage delinquencies was eroding the stability of the broader housing market. Source: Federal Reserve report. The analyst's spreadsheet began to look like a death march. Each new data point nudged the curve closer to a breaking point. As the numbers stacked, a chilling realization set in. The securities he'd been monitoring were not merely risky. They were structurally unsound, a tinderbox primed for ignition. He whispered to a colleague, "If this unravels, the whole market will implode." The colleague's eyes widened, but the analyst's own face went pale, his own words echoing in his mind. "This will collapse." The gravity of his discovery was magnified by a GAO audit that later concluded regulatory gaps allowed the proliferation of poorly underwritten securities. Source: GAO report. The analyst understood that his warning was not an isolated alarm, but a signal that the entire architecture of mortgage-backed securities was compromised. He tried to raise the alarm internally. Emails slipped into inboxes, memos attached to board decks, each bearing a stark headline: "Systemic risk detected in MBS portfolio." Yet the response was muted, the language corporate, the urgency diluted. The analyst's pulse quickened, the weight of potential catastrophe pressed against his chest. Outside the walls of the bank, the IMF was already charting the global fallout. Its 2016 economic outlook warned that the ripple effects of the crisis extended far beyond national borders, reshaping growth trajectories worldwide. Source: IMF report. The analyst's private dread now had a public echo. The collapse he feared would not be confined to a single market. It could cascade through economies, destabilizing everything from sovereign debt to pension funds. The stakes rose further when the U.S. Treasury's Financial Stability Office released a briefing that outlined the urgent need for coordinated action to restore confidence in the credit markets. Source: U.S. Treasury report. The analyst's discovery, once a solitary note, now intersected with the highest levels of policy response. In the dim glow of his office, the analyst stared at his spreadsheet, the rows of mortgage-backed securities turning from numbers into a map of impending ruin. He felt the room tilt, his breath shallow, as the magnitude of the hidden debt surfaced. The words that had once been a hushed warning became a mantra. This will collapse. His next move would set the stage for a chain reaction, one that would force regulators, investors, and the public to confront a crisis that had been silently building under the veneer of high-yield promises. The story that follows is not just about a single whistleblower, but about the fragile scaffolding that held the world's financial system together, and how a single line of data can shatter it. Stay with us as we trace the analyst's path from quiet discovery to public reckoning, and explore how the warning that turned his skin ash white reverberated through markets, governments, and households across the globe. So the 2008 financial crisis, it was a really big deal, a catastrophic event that shook the entire global economy. At its core, you had the collapse of the mortgage-backed securities market, which is pretty complex. To get a handle on how this all went down, we need to dive into the world of mortgage-backed securities and the lack of regulation that let them get out of control. The mortgage industry in the years leading up to the crisis was kind of like the Wild West. There was a serious lack of oversight and regulation, which led to a ton of subprime loans being handed out. Source: these loans were given to borrowers who honestly might not have been able to afford them, and they were often based on adjustable interest rates that would increase over time. Not a great combo. As demand for these loans grew, so did the market for mortgage-backed securities. It's like they were feeding off each other. These securities were created by packaging many individual mortgages into a single financial instrument, which could then be sold to investors, the idea being that by spreading the risk across many different mortgages, the securities would be more stable and less likely to default. But the reality was that many of these securities were based on subprime loans, which were way more likely to default. It's like building a house on shaky ground. The investors who bought these securities were often in the dark about the risks involved, since the true nature of the underlying mortgages wasn't always clear. Source: this lack of transparency and accountability in the financial sector was a major contributor to the crisis. It's like they were playing with fire and got burned. The whistleblowers' discovery of toxic mortgage-backed securities highlights the need for greater oversight and regulation in the industry. It's a wake-up call. If investors had been aware of the true risks involved, they might have been less likely to invest in these securities, and the crisis might have been less severe. The impact of the financial crisis was felt all over the globe, with households and mortgage markets being particularly affected. Source: the crisis led to a significant increase in mortgage defaults and foreclosures, which in turn led to a decline in housing prices and a decrease in consumer spending. It was a ripple effect. In the aftermath of the crisis, there were a lot of calls for increased regulation and oversight in the financial sector. People were saying, "Hey, we need to do something about this." The U.S. government implemented several reforms, including the Dodd-Frank Wall Street Reform and Consumer Protection Act, in an effort to prevent similar crises from occurring in the future. Source: the International Monetary Fund, IMF, also played a role in responding to the crisis, providing financial support to affected countries and implementing policies to stabilize the global economy. Source: in addition, the U.S. Treasury Department took steps to restore financial stability, including the implementation of programs to support struggling homeowners and stabilize the housing market. Source: the 2008 financial crisis was a complex and multifaceted event, and the role of mortgage-backed securities was just one part of the story. There were a lot of moving parts. However, it's clear that the lack of regulation and oversight in the mortgage industry, combined with the lack of transparency and accountability in the financial sector, contributed significantly to the crisis. It's like a perfect storm. As we move forward, it's essential that we learn from the mistakes of the past and work to create a more stable and secure financial system. We can't just keep doing the same thing and expecting different results. This includes implementing robust regulations and oversight, as well as increasing transparency and accountability in the financial sector. It's a tall order, but it's necessary. By doing so, we can reduce the risk of similar crises occurring in the future and create a more prosperous and stable economy for all. That's the goal, right? The whistleblower's discovery serves as a reminder of the importance of vigilance and oversight in the financial sector, and the need for individuals and organizations to speak out when they witness wrongdoing. It's like a call to action. The warning blared like a siren, yet Wall Street's corridors stayed stubbornly mute. The whistleblower's memo laying out the toxic mortgage-backed securities was submitted, then tucked away. Regulators skimmed the pages, investors waved it off, and the market just kept humming along. When the first slice of default struck, the damage hit instantly. Homes disappeared from balance sheets, banks' capital seemed to evaporate. The SEC's own study later noted those securities played a central role in the financial crisis. Source: SEC report. Households felt the shock as it unfolded in real time. Families watched mortgage payments vanish, credit lines freeze, and savings melt away. The Federal Reserve's crisis analysis confirmed that the impact on households and mortgage markets was profound. Source: Federal Reserve Report. The whistleblower, still an anonymous figure, observed the collapse, pale but resolute. In a later interview, he described the instant he realized his warning had been swallowed whole. His bravery, standing alone against a tide of complacency, became a quiet rallying cry for reform. Across the nation, panic morphed into a cascade of failures. Insurance firms scrambled, credit markets seized, and the Dow took a sharp dive. The GAO later judged that federal regulations had failed to prevent a repeat of the crisis. Source: GAO report. Globally, the shockwaves rippled far beyond U.S. borders. Emerging economies felt capital flight, global trade contracted. The IMF's overview flagged a significant worldwide economic impact from the crisis. Source: IMF report. In the aftermath, policymakers scrambled to stitch together a broken system. Treasury officials drafted a slew of emergency measures aimed at shoring up liquidity. Their own report stresses efforts to restore financial stability after the crisis. Source: U.S. Treasury report, yet the whistleblower's message still reverberates in the halls of power. Legislators cite his testimony when debating tougher underwriting standards. His courage, once brushed aside, now fuels a narrative of accountability. The fallout keeps shaping everyday life. Mortgage borrowers still navigate tighter credit, and banks watch risk models with a wary eye. The lingering need for reform isn't a slogan, it's a lived reality for millions. Every fresh loan, every securitized bundle carries the ghost of that ignored warning. Regulators now demand more transparency, yet the shadow of the past looms large. The whistleblower's story reminds us that truth can be a fragile shield. When a single voice cuts through the noise, it can spark change or be buried beneath it. Today, the financial architecture bears the scars of that collapse. Stress tests, capital buffers, and consumer protections are the hard-won legacy of a crisis that might have been averted. The question remains: will the system heed the warning before the next wave crashes? The answer sits in the balance between profit and prudence, and in the willingness to listen to those who dare to speak truth. The whistleblower's pale face, the ignored memo, the devastation that followed, these aren't just history. They serve as a call to vigilance, a demand for reform, and a testament to the power of one voice against a tide of indifference. You know, the 2008 financial crisis was basically a huge wake-up call. It exposed some pretty shady stuff in the financial sector. And as it turns out, we still really need some regulatory reform, even today. The SEC report on mortgage-backed securities is a great example of this. Source: the whistleblower's story is a real eye-opener, reminding us how important ethics and accountability are in the financial sector. So if you look at the Federal Reserve report, you'll see that the financial crisis had a devastating impact on households and mortgage markets. It's pretty shocking, to be honest. Source: then there's the GAO report, which evaluates how well federal regulations are working to prevent future financial crises. And let's be real, we need to keep a close eye on things. Source: the IMF report gives us a bigger picture, showing us the global economic impact of the financial crisis. It's a lot to take in. Source: meanwhile, the U.S. Treasury report talks about the efforts to restore financial stability after the crisis. It's worth checking out. Source: now's the time for all of us to take action. We need to demand more transparency and oversight in the financial industry. We can't just sit back and do nothing. We've got to learn from the past and work towards a more stable financial future. The need for reform is honestly pretty urgent, and it's gonna take all of us working together to make it happen. By pushing for change, we can prevent similar crises from happening and build a more resilient financial system. So let's get to it. The time to act is really now.